Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering risk and money management. It probably could also refer to this more or less as trade management. So we kind of talked about trading psychology and how much you want to risk per trade. Now, you have to understand that every trade you enter is literally a 50-50 shot of which direction it goes next. There are ways to put odds in your favor. So, one thing that I would say is, this is the Australian dollar, but you can see since February 21 to November 22 year, that is, for the most part, you've made easier money on the way down. We're in a trend. So that's the first thing about money management and trade management, risk management that you need to keep in mind. You don't want to fight the market. Now, we happen to be in a massive move higher at the moment, as you can see, but I think a lot of people get stuck looking at the chart like this and going, "Oh my god, we're going to the moon," when they don't look at the chart like this and say, the Aussie has been stronger in the past quite a bit. Um, Retail traders have a long history of trying to pick the bottom, and picking the bottom is a great way to get wiped out. Um, just simply put, you have to be very cautious because there are multiple times along this way where we bounced a bit. You can say, "Oh, look, there's a double bottom, time to start going long." And while that did work for a short amount of time, the reality is the trend changes in the Forex market, and this is part of knowing your market, tend to only happen every 3 years or so. That's obviously not always the case, but that's about 3 years. That's about 3 years. That is only a year and a half. And this is a year and a half. But this, '02 to '05, or 1 to '04, sorry, '01 to '04 was an uptrend. We did pull back a little bit this year on '04 and then kind of consolidated, but '06 to late '08 was an uptrend. Had a massive sell off there. '08, well, we all know that was a financial crisis. '08 to 11, 3 year trend. Now, granted, you can't base everything on that, but that gives you an idea of why the trend matters. Um, I'll just go into it'd be a little harder with crypto because crypto's so new, but I'll just go into a stock, something with a long history of trading. Okay, Google. Google's been in an uptrend forever, right? So that being said, until recently, until uh, late 21, for the most part, if you bought Google, you made money. There's been a couple of nasty little pullbacks, but you can clearly see that there's only been one way to trade this market. And there's always somebody out there willing to jump in and say, "Oh, no, 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 this is the end." But they don't tend to be profitable. You can even look at this in indices, S&P 500. Yes, it's been a pretty nasty correction, but when you look at the S&P 500 going back to 79, I mean, you've still made most of your money on the upside. Does not mean that you cannot make money on the downside. It's just that it's easier. So that's the idea I'm basically trying to pound into your head here. So knowing this, if we um, decide to trade a stock, I'll pull up NVIDIA here. You can look for different ways to take your profit or place your stop loss. So, this right now is going to come down to support and resistance more than anything else. So I'm just laying out quick lines that I see. Um, I'll clean them up here. So, for example, 165. Remember, it doesn't mean to the penny. It just means that's your general area. Let's see. So let's do 200 here. 120. Okay, so this is your weekly chart, and you can see that these are major weekly support and resistance levels. So if you break out above here, where's the next logical place you go? Somewhere near here. What you're looking for is some type of chart pattern, candlestick, something like that, that's going to tell you we're running out of momentum. Speaking of which, you can also add like a MACD. Well, the MACD is starting to cross here, and the histogram just went green. So that tells you we were oversold. We'll see if we bounce. Very possible that we do. It's been a pretty brutal sell off. So at the very least, you would think so. Alternatively, if we show signs of exhaustion here and we pull back, well, where do you think we're going? Well, maybe as low as 120. Now, I use the weekly chart because it's a little easier to kind of spot where we could go. But you can lay out your lines on the weekly chart, then take a look at the daily chart. Well, right here, you can see it's going to be a fight for this to break out. That's why I think it's such a big sign if we do. If we pull back, which I can't say that I'm expecting, but I certainly would keep my eye on, then it's possible we drop back into the 120 level. Or on the daily chart, you can also see that this area right around 140 has mattered. The trick is to find areas that have been important multiple times. Because if you start laying out like weekly, daily, hourly, etc., you end up having so many lines on the chart you can't do anything. But you can see 140 has mattered back here as well. So let me ask you this. If you are going to short this market, let's just say you get a signal to start selling. Where do you want to put your stop loss? Well, you put it above here. You put it up there because the market's going to have to break through that resistance to take you out. And you target down here. If you jump below there and you're still in the market, then you can move your stop loss up there. It's just a way of letting the market tell you when it's time to get out. Your job is to just sit on your hands and let the market do its thing. There are other tools you can use. So, um, for example, let's do Binance Coin. So some people will use what is known as a Fibonacci retracement, which actually is uh, something we'll go into in more depth in the next video. But suffice to say, we're in a downtrend. That's your swing high, your swing low. You draw from there to there. 50% of the move is retraced. You form a candlestick known as a shooting star. You start selling and aiming down there. Where do you put your stop loss? Some would put it directly behind the Fibonacci level. Some would put it behind the one above it. This is thought of as dynamic support and resistance. The mechanics of it don't really matter. It just gives you an idea. Like from here, the 50%, or excuse me, the 38%, 38.2% is here. And we continued. So you can use a tool like that. And like I said, we'll go into Fibonacci next video quite a bit more. But really, it comes down to support and resistance more than anything else. You have to let it guide you in order to take advantage of buys and sells. You can also take a look at volume. There are going to be times where, so like this U pattern here and this sudden spike. So notice how we rallied right into this resistance here at about 170. We ended up forming what is known as a hanging man. That's a bearish candlestick. So you can make an argument that we peaked there and volume started to drift lower. Shooting star candlestick, very bearish candlestick. We did spike just before it and lost volume. So volume can come into play as well. More than anything else, though, I would impart upon you to pay attention to those support and resistance levels because they tend to appear time and time again. Um, they're not always perfectly laid out, but you can see this is an area where markets have reacted to, maybe not as strongly as there, but it mattered. This is a pretty strong area. So breaking through there, pulling back to there, and falling again makes a lot of sense. You can say that we formed a double bottom there. We bounced, and went higher. That's an area that should be important. We had to gap below it to continue going lower. But it certainly had a nice bounce trade form from it. Now, as far as money management, like I said in the last video, it's going to be number one, it's going to be a matter of how much can you psychologically do. And then secondly, you need to worry about um, being able to deal with a string of consecutive losses. For example, if you are taking 16, or if you're taking 16 trades, statistically speaking, you will get four of the same in a row once every 16. So, statistically speaking, um, you would have the likelihood of four wins in a row, but you also have the likelihood of four losses in a row. So if you're betting a percent on each trade, you could lose 4% in a string of trades because you have a 1 in 16 chance of getting four in a row. Doesn't mean you have to get it this 16 trades. It's just statistically speaking. Um, that being said, every time you go further out, then you double the amount of times that you may hit that many in a row. So, for example, if it took five losses in a row to wipe out your account, you're talking it'll happen one every 32. If you decide that you want to make it so that it's even more difficult, you remove the drawings. The odds of hitting 100 of the same results in a row, be it wins or losses, is expressed mathematically. I don't want to get too far into the weeds here. Is 1 in 2 to the 100th power. What does that mean? Um, this is the odds of that happening. So, in other words, I still have more numbers to write, believe it or not. In other words, the odds of having 100 losses in a row, assuming that you have a system that is 50-50, comes out to that. It would be easier to win the lottery. So keep that in mind. Um, that's why a lot of people come up with 1%. Now, again, does it fit your psychology? Maybe, maybe not. Um, but that tells you how quickly things can change if you're betting, you know, one out of every 32 trades. If you're going to bet 20% of your account, meaning you would have five losses wipe you out, that is something that is going to happen every 32 trades, so you're going to be in trouble. But if it's going to be something that it's going to take 100 in a row, you saw that number. I don't even know what the name of that number is. It's so big. Obviously you're probably going to find somewhere in between that you're comfortable with, but nonetheless, that gives you kind of a quick overview of just how position sizing comes into play. just how it's all about stats. I mean, you have to assume that some of the best traders in the world actually, you're looking at a win rate of about 55%. Now, they overcome the statistical edge, and casinos will kill for that edge. But they overcome this statistical edge because number one, um, they let their winners run and they get rid of their losers pretty quickly. So some of these traders might have like a 1 to 5 ratio. Some might have 1 to 3, whatever. The point is that they are aiming for much more than they are risking. That's the other part of this that doesn't get talked about enough. So make sure that for every dollar or euro you risk, you're trying to get at least three. Um, I mean, bare minimum too. But the higher the number, the better. But you also have to understand that if you're going like 1 to 10, 1 to 20, you're going to have more losses. Um, but it is possible, it's statistically possible if you are going for 1 to 20 to only be successful like 10 or 12% of the time and make money. But you have to have the psychology to hang on for what will certainly be a string of losers in a row. So you definitely have to, this is kind of on you in the sense where the best thing that I can do is give you some things to think about and then some exercises like I said, changing your position sizing and walking away from your computer and going on about your day and seeing how that plays out. Um, there are no two identical traders out there. There's an old study that people talked about where you could have two traders using the exact same system and one will make money and one won't. Well, it comes down to money management, it comes down to psychology, being able to hang on to trades, things like that. So in the next video, we'll talk about mastering Fibonacci tools, which I kind of showed you a little bit in this video.